news and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London. I want to start off with the earnings story because that's what seems to be what's moving the markets the most, because you are seeing some green on the screen when it comes to those financial services. You are also seeing green on the screen when it comes to the likes of BP. But Diageo is the one that's taking a beating. And this is interesting simply because it's down about 10%. It's talking about a weaker U.S. consumer, a weaker product demand story in Latin America as well, which is one of their main growth areas. And the idea of headroom to actually hike up some of those prices to boost some of those volumes is not quite there yet. And again, that is significant for the broader macro story. We're going to revisit some of those numbers later. BP also higher this morning, despite actually some concerns around some of their refining margins. They're sticking with their buybacks. They're keeping them steady. And that is a big win in this market, higher by about 3%. That is going to be crucial. Some green on the screen for Standard Chartered as well. Again, a record buyback plan coming out of Standard Chartered. They're actually saying we're seeing more wealth consumers in Asia, and that is feeding into our bottom line. That is all positive for the buyback story. And of course, St. James, again, net inflows, again, wealth at the very top of that income brass, really feeding into some of these financial managers. A whopping almost 20% gain for the company. St. James there, of course, we're going to be diving into that story later as well. Let's go a little bit broader here and talk about some of the GDP numbers that are breaking, specifically when it comes to Germany. Now, we are waiting for the headline CPI number that's going to come in about 1 p.m. UK time. But for now, when you do actually look at those German numbers, the GDP forecast is coming in, falling by about 0.1% quarter over quarter, bang in line with estimates. So you're not seeing that much reaction in terms of the European story. We are, however, getting some of the regional data, and I think that's where perhaps we pay a little bit more attention. I want to go into the CPI numbers coming out of Saxony, that crucial area as well. On a month-over-month basis, you're looking at a rise of 0.6%. The prior was 0.1%. So this is interesting coming out of Saxony. When you look at North Rhine-Westphalia, which is the other one, Westphalia, I should say, which is the other one we keep our eye on, the year-over-year number is 2.3%. The prior was 2.2%. So I would say hot numbers in those parts of the regional story. How much of that shows up in the data that we are going to see in the 1 p.m. Session or in the 1 p.m. kind of data deluge as well? That's the Germany story, especially in the context of that weakness. Let's talk about Italy as well, because you did get those preliminary second quarter numbers. The GDP there rising, again, bang in line with estimates. That is on a quarterly basis. The year-over-year basis is about 0.9%. The estimate was 1%. I think the takeaway here, broadly speaking, is that the outperformance in GDP numbers is coming from France and is coming from Spain in the last quarter. But the CPI numbers are coming in hot as well everywhere. So this idea that perhaps that disinflationary trend is accelerating, I'm going to throw a little bit of cold water on that in terms of the data that we get this morning. But don't take my word for it. Let's bring in a true expert. Freya Beamish, chief economist at TS Lombard, joins us this morning. Freya, I am losing my breath to keep up with all of this data, but I'm curious where you think the strength is coming from in Europe.
Yeah, I don't see it as lasting very long. I'm on that side of it. I think we have had a little bit over the beginning of the year, turning in the trade cycle, some improvement in industrial production. When I look sort of to the next kind of 12 months or so, what I'm worried about is that this data today will prove to have been a bit of an illusion, that policy is too tight, and that we'll be seeing the repercussions of that with the kind of the lags feeding through over the next kind of 12 months or so.
So when we talk then about where the cues are coming from in terms of the European economy, are we still very much paying attention to that manufacturing weakness in Germany? And I'm putting that in the context of that weak EFO data that we got last week as well. I'm curious if that is still the sticking point, or do we need to be worried about cracks showing up in Italy and France, or is this still very much a Germany story?
It's very focused on Germany because Germany is the one where kind of there's been a big global shift here with sort of the relationship with China. The sector is very exposed to the economy has sectors that are very exposed to tight policy. So a lot of that kind of industrial story of industrial weakness, construction weakness, is partly related to China, but also a lot of those same sectors are very related to, are very sensitive to over tightening of monetary policy. So at this stage in the game, it's hard to sort of work out exactly which one of those is the driving force. But certainly policymakers have control over their own policy, and they don't have control over the relationship with China. So I think we'll see policymakers starting to move more rapidly as we go through into the next kind of 12 months or so, really catching up with where they should have been earlier in this year.
So, Freya, in the last week or so, you've started to see the market, and a lot of this is coming off the data that we got in the States, start to price in cuts in September and actually double down when it comes to what the Federal Reserve is going to be doing next. Is the ECB and the Federal Reserve officially on the same page? Is that narrative of policy divergence in the rearview mirror?
Yeah, I think the ECB was always going to have to cut first, was always going to have to move first, because the strength, the demand strength was always in the US. There was a positive aggregate demand shock in the US, and there wasn't elsewhere in the world. There was just a preservation of demand. So it was always going to be that the US was going to take longer for things to feed through, and that sort of breaks with the traditional relationship between the Fed and European central banks. I think we're now getting to the stage in the US where, as Powell is saying, that the two parts of the mandate are coming closer into balance. So we'll see the Fed starting to get onto the same page with cuts there, and that should come through in September.
Well, it feels like they're responding to some of the cracks that we're seeing in the data. And by the way, we're seeing it in the corporate space as well. We just had a conversation in the last hour with the CEO of Diageo. We had some poor numbers coming out of McDonald's as well when it comes to the consumer story. Walk us through the delay here. Let's say they do cut in September. How does that show up to the end consumer? And does that help maybe stem some of the pain, some of the weakness you're seeing in the States?
Yeah, I think the pain actually for me in the States is probably a short-lived thing. So around in the first half, sort of around Q1, we were starting to see deterioration in the leading indicators with regards to the labor market. That tells us that there's probably a soft patch coming through in the middle part of the year. But since then, we've actually seen some of those leading indicators start to bottom out, which tells me it's more of a soft patch than a sort of a serious deterioration. I think in order to get ahead of the curve, the Fed probably does need to start cutting now. On the QT side of things, I'm not quite as concerned. I think there's still a lot of liquidity out there. It doesn't seem as though we're running into any plumbing issues at this stage in the game. But certainly in the lower income parts of the distribution, that's where we're starting to see people running out of money, and maybe that's where some of the softness is coming through. Similarly, small firms that are not represented by sort of market moves and kind of are not really picked up in credit spreads, much more reliant on banking. Those types of firms are probably running into difficulties at the moment. So a rate cut is appropriate to sort of bring those guys, or to sort of soften things a little bit for those parts of the economy. But overall, we still see reasonable resilience in the U.S. economy.
So that resilience that shows up in the U.S. economy, that may catch that tailwind in September if we do get a cut, also has global implications as well. Freya, to what extent does the November U.S. presidential election get in the way of what the Federal Reserve may need to execute in the back half of the year?
Yeah, it's a tricky one, and certainly Trump has been talking about, trying to ward off that cut, talking a lot about inflation. I'm assuming that he's more worried about them cutting, and that's why he's talking about inflation rather than he's actually genuinely worried about the stickiness of inflation, because most of his policies seem to be pushing in the direction of a more inflationary economy, which is not necessarily a bad thing if it happens within within the confines of strong institutions. What we like about the U.S. economy from a kind of a 2 to 3 year time horizon, thinking about U.S. facing stocks, thinking about real economy facing stocks, is that there does appear to be this repressurization of kind of politicians on both sides of the House listening to what's required of them by the electorate, which doesn't really seem to be coming through to the same degree in Europe. And that kind of repressurization, in which you get tight labor markets feeding through to strong capex growth, creating productivity growth, all of these lovely kind of synergies that have been dormant for the past kind of 15 years or more. Those types of things are what we're looking for over the kind of the 2 to 3 year time horizon. I think coming back to your question, in the meantime, I think the Fed will probably do what it perceives is necessary to be done, and suffer any kind of political consequences.
All right, Freya, Beamish, we have to leave it there. Of course, keeping apprised of the not only the Fed's path, but where the U.S. political story goes as well. Chief Economist over at TS Lombard, we thank you so much for putting that into a little bit of perspective. Coming up, it's a tale of two corporate stories this morning. A sobering result for Diageo, the maker of Johnnie Walker and Guinness, reporting its first fall in annual sales since 2020. A lot of the pain coming out in the Latin American sector as well. Weaker consumer story out of the States that we were just talking about with Freya combined with some strength out of BP. We're going to dive into the details next. This is Bloomberg.
We are faced with a challenging U.S. environment, just like many other consumer-facing companies. We're calling it a cautious consumer, a U.S. consumer that's quite cautious in spending. Wallets are under pressure as inflation is persisting. You're seeing, 30-year high grocery, food basket prices. And that has certainly impacted us. Additionally, interest rates remain high, and so that's impacting retailers. We've had some retailer destocking this year.
CEO of Diageo, Deborah Crew, they're talking about the inventory story, talking about that potential weakness you are seeing in their numbers as well. That is showing up in the stock market in a really big way. The shares plunging after that slowdown in Latin America, the Caribbean, and the U.S., talking about the potential weakness in the U.S. consumer, also talking about the LATAM being their bigger growth area. You combine that with the green on the screen we're seeing in the likes of BP, for example, makes a very interesting market trade. Buyback seem to be the story in the oil space right now. Let's dive into both big stories. Bloomberg Saba Meddings joins us around the table alongside James Harrant, who we'll get to in a moment. There's a lot going on here. Bear with me, but let's start with the drink space. Let's start with the negative, because we are journalists at the end of the day. We got to start with the doomsday. This is fascinating to me because we had Heineken come out yesterday and tell a similar story about that consumer weakness. How much of this is drink specific?
Well, I mean, they're both obviously quite different companies. Heineken very focused on beer, Diageo very focused on spirits. Obviously, it sells Guinness as well. What you've traditionally seen is as consumers have perhaps switched away from beer, companies like Diageo have benefited. What we saw today is this whole move to premiumization that you've seen with Diageo is actually kind of coming back to burn them a little bit, because there is that real cautious consumer. They don't want to spend as much. And if we look at the US, volume's down 4% for Diageo in its biggest market, and a big falls come from tequila, which has obviously been a great growth for them. We saw Casamigos, one of their brands, down 22%. So people are definitely spending less. They're kind of running down what's already in their cabinet at home. And then you're seeing retailers order less because they don't want to get stuck with these big inventories. So it's really interesting. And also, like you say, the sort of the forward look, there doesn't seem to be any sign of this kind of picking up. It was quite a stark commentary we had from the company today. Yeah, and I found it fascinating because, of course, we just heard from Deborah Crew when she was on the program with us. She was talking about, I've never heard a drink maker really talk about this, but interest rates affecting purchasing ability for things like spirits. I've never made that connection before, but she makes a crucial point in that that's kind of the part that's eating into their bottom line, and that the pricing pressure is so large that they don't actually have that headroom. That's something we heard from Heineken as well. So what gives first, the volumes or the pricing? Well, I guess that it's a balancing act, isn't it? They kind of have to decide, do we push up pricing to sort of protect our margin, or do we hunt for volume? I think it's going to be an interesting one to watch in the coming months as they try and work out that balance. But definitely we are seeing volumes fall. And, yeah, as we saw that sales fall as well. So it kind of looks like they're losing both at the moment. Yeah, it's fascinating, especially at a time when I think there's a lot of pressure along companies broadly to just kind of stick to what they've promised. And I think Diageo maybe didn't do that this time around because they were so excited about the Latin American story. And I would say that's maybe where BP, by comparison, actually won, because they made some big promises on the buybacks. There was concern they would go back on those promises, and instead they didn't. James, walk us through this buyback story for BP.
Yeah, as you say, there were some questions, given there's a lot of weakness in the oil market. Questions about demand, refining industry has been pretty poor. But BP stuck to its buyback. It increased its dividend by as much as was expected. And the story there really is the strength of the profit is coming from the core of their business, pumping crude out of the ground. Yeah. And the reason that they're making so much money in that is largely down to OPEC. OPEC has been restraining production all this time. And even though demand is looking a bit soft, OPEC for the moment is still cutting production. Oil has been above $80 a barrel for most of the past quarter. And so that really was the big driver of profits for BP.
So understandably, and then the buybacks are clearly what's driving the stock this morning. But there is still that concern about refining weakness, that margin weakness as well. Can you talk to us a little bit about the trading weakness that we might be seeing in BP, especially, and I want to ask you about Vitol, but we should point out that Vitol just announced a record buyout, $6.5 billion in terms of a dividend. Where does BP stand in terms of their trading business?
Yeah. And I think trading looks weak now because of where we're coming from. So the Vitol numbers we saw, the incredible dividends they've given to their employees, were for 2023. And BP and the other oil majors made huge amounts of money in those years too, because price volatility was sky high. They were making a lot of money trading gas around the world. So we've come back to more normal levels for trading profits, but obviously that seems low now in comparison to what we've seen for the last few years. So they've had to fall back on their core business, which is, pumping oil out of the ground.
All right. So, again, a tale of two corporates, a really fascinating one. There's a consumer story in both of them. Bloomberg's Saba Meddings and our leader of European oil, James Harren, joining us both this morning. We thank you so much. Coming up, we're going to dive into a little bit what James was just talking about in terms of geopolitics and some of what's going on in the Middle East and Venezuela, by the way, driving some of that oil story. We're going to dive into the Venezuelan story, where the opposition says it has proof of election fraud as thousands take to the streets to protest what they say is Maduro's illegitimate win. We're going to dive into the details next. Stick with us. This is Bloomberg. Now focus on election results over in South America, where Venezuela's opposition party says they can prove that it won Sunday's election as protests broke out in the capital, Caracas, following the disputed vote. I want to get more on the details here, bring in Bloomberg's Alan Crawford, who, of course, has been following the story detail by detail. Alan, can you just give us a lay of the land here? What do we know? What's the latest?
Well, after those scenes of protest that we saw yesterday, then the leader of the opposition, Maria Corina Machado, who of course was barred from standing, she wasn't allowed to stand, she said that the opposition's main candidate, Edmundo Gonzalez, they had proof that he had won by something like 70%. So that was stepping up the confrontation against the president, Nicolas Maduro, who of course claimed victory. He, meanwhile, then issued a statement late at night where he declared, he'd announced the protesters as criminals, said they were being paid $150 to turn out. So essentially the tensions are ratcheting up.
And is this something that the rest of the world has a view on? Walk us through the international reaction.
Well, to some extent, it's been business as usual, in the sense that you saw that predictable allies, Russia and China, lining up behind Maduro. The US said that it had serious concerns about this election result. But I think what's arguably more interesting is that some of Maduro's, what might be regarded as regional allies, leftist governments in Brazil, of Lula in Colombia, next door, of Petro, and also of Mexico, they were coordinating. They were clearly unhappy with this outcome. They have questions, and so they've been coordinating their response, and I think that that's key to watch.
It's certainly something we're going to be watching as we monitor the developments and see whether or not some of that international reaction can actually move the dial when it comes to Venezuela. Bloomberg's Alan Crawford, we will leave it there, but we thank you so much for that crucial context, of course, as we watch the geopolitics there and we watch how that shows up in some of the market reaction. We've got our eye on Venezuelan dollar-denominated bonds. We've got our eye on oil prices as well. Limited exposure when it comes to Venezuelan oil in terms of the international market, but something we're going to be keeping an eye on. And something I'm keeping an eye on in this part of the world is going to be those European movers, and specifically in the stock market, where we are seeing off the back of earnings, Diageo taking a big beating, down about 10% relative to St. James Place, which is seeing massive inflows and a massive stock rally on the back of it. Those shares higher by 21% amid a sprinkling of other positive numbers. We're going to dive into it. Stick with us. This is Bloomberg. Good morning and welcome to The Pulse. I'm Kriti Gupta in London. Let's get to your top stories. It is earnings palooza. BP shares rising after a profit beat, keeping its buyback steady and hiking its dividend. On the other hand, oil trading giant Vitol posting a record $6.5 billion payout. It is not all calm seas. Diageo sinking as a slowdown in Latin America, the Caribbean, and the U.S. push the distiller to its first annual sales decline since the pandemic. A weaker consumer story weighing on those shares. Plus, Bunds erasing their earlier gains after German GDP data surprising to the upside with a drop in the second quarter, but the inflation number surprising to the upside, In contrast, France and Spain growing far more than predicted. Let's go back to the banking story because that's where a lot of the action is this morning. Standard Chartered making waves as the shares are higher by about 6%. The London-based bank saying it would ramp up its multi-billion-dollar share buyback program. Now, this all comes as reported a beat on second quarter pre-tax profits driven by its wealth business.
What we've said to shareholders is we've got a strategy. We're pursuing the strategy. It's working quite well. Earnings are strong. We're managing our capital very, very directly and I'd say quite actively. And that's allowed us to return any surplus to shareholders. And we've said, especially given where our stock price is, which is not as high as we think it should be, we will buy back as many shares as we can with surplus capital. That's what we're doing. If we keep on performing, of course, we can keep on buying back shares.
A strategy that's working, says Bill Winters, the CEO of Standard Chartered. Let's get a little bit more analysis here because it's not the only company that came out with pretty strong numbers. Nomura did, so did St. James, and you're seeing some pretty big moves off the back of it. I want to bring in Filippo Alloatti, head of financials over at Federated Hermes, for a little bit more analysis. Let's start with the Standard Chartered story because this big boost and the announcement for the buybacks is really coming off strength that they're seeing in Asia. A wealthier client driving their results is similar messaging you heard out of Nomura. Where did this come from, especially in the backdrop of Asian weakness?
Yeah, not exactly. It's an interesting point because we're seeing all those companies coming out also with strong number from especially the Asian wealthy. And I guess that's what my reading is that the wealthy people in Asia are actually better than we made up them to be. And I think Bill Winters in this context is very right. Because it's clearly said that there are opportunities that are very expensive, so it's better just to return the money back to the shareholder as they achieve the return targets.
Well, Standard Chartered isn't the first to talk about this. I think in the last earnings season, we heard likes of Unicredit, Commerzbank, Deutsche Bank talking about these massive buybacks, and it felt like so much of that was coming off of just cash they were sitting on, given kind of this tailwind from net interest income. Does the buyback story end this quarter?
No, I don't think so. I think it has a few more quarters to run, and I think it's for a number of reasons. The first one, that versus the expectation at the beginning of the year, rates cut have been few and far between. In fact, we only had one from the ECB so far, waiting for the BOE on Thursday, of course. And on the second point, it's actually the deposit beta versus previous cycle, so how much the banks return to the depositor in terms of increased deposit remuneration, actually have been a lot lower than in the previous cycle. So the combination of those two factors has been a powerful propellant to the net interest income of all the banks. That's why we see all those banks actually not only confirming the full year guidance, but actually increasing. Unicredit, I think, is a case in point. Yeah. I believe I'm lost count how many times they upgrade the full year net interest income.
Well, okay, so let's macro this out then. When it comes to interest rates, and this is why it's interesting that you say this is a multi-quarter story when it comes to the buybacks, because should we be paying attention to the net interest income or the net interest margin even, given that the expectation is that the ECB is about to kind of hype up and ramp up their cutting cycle?
Yeah, that's the crux of the matter. I personally think that inflation is here to stay, so I don't believe in this disinflationary story. I'm one of the few left in the street.
I was going to say, you are the contrarian there. Yeah.
But I think, inevitably, maybe 12, 18 months down the road, there will be a more focus on the fees and income. And then I think I think it will tail off with the share buybacks inevitably reducing. But I think as I said, share buybacks are here to stay for the next few quarters. And then, of course, will become more a question what the banks do. Who's the best bank position for potentially less revenue from the banking income?
So it's interesting. We're talking about this kind of fee advisory and the fact that, and this is also coming, I should say, in the context of a capital market that capital markets globally, that it hasn't quite ramped up that I think a lot of people wanted. And it's interesting that the wealth business is offsetting some of the kind of IPO and deal-making business that we're still waiting to see. You see that a big concern in the private markets really talking about that. And yet there is a concern around loan loss provisions, around cushioning, around some of the capital buffers that are now being required in Europe, even though the United States has kind of pulled back on some of that as well. I'm throwing a lot at you here, but stick with me. I'm also looking at a price-to-book ratio, and this is where Standard Chartered kind of highlighted themselves. Price-to-book ratios that are rising for a lot of the banks. Square all of that for us. If we're talking about caution when it comes to loan loss provisions and capital buffers, and yet the prices driven by buybacks is rising, those feel like contradictions to me.
Yeah, up to a certain point, in the sense that especially the European banks, including the UK ones, they were on very depressed price-to-book multiple for a number of reasons versus, for example, Australian, Asian and American banks. One of the reasons also was the harsher regulatory environment in Europe, in the UK, post the global financial crisis. I think we're removing a bit of this. It's still tough, but it's less harsh than it used to be. And that's why the banks also have built over the last 15, 16, 17 years, in my opinion, huge capital buffer. For example, just to mention one, UniCredit still has 1.7 billion euro of so-called COVID overlay, which... And I think also another point, just to help in squaring this equation, there is also the economy, notwithstanding what we read in the papers, it actually is not that bad as we fear it could be a year ago. So we're talking about...
In the broader European economy? Or
broader European economy. I mean, of course, also we know Germany has... potentially is drop into recession, but the other parts, Spain is growing 0.8%, Italy is growing 0.2%, of course also France 0.3%. They're not great per se, but I mean it's hardly a very bad recession, which some of us also were fearing last year. So the fact that the economy actually is cooling down but is still slowly growing, that's explained why the asset quality trend, barring a few, a few specific sectors, like for example construction and commercial real estate, that actually the loan provision has been behaving in line. That's why some of those firms, some of those banks, they're coming out with relatively sanguine full-year cost of risk estimates.
Well, it's interesting that you talk about this in the context of strength in Europe, or the economy perhaps not reflecting or coming at some contradiction to some of that weakness, I think, is the point that you just made. Where does cross-border consolidation come in that? And the reason I ask this, and I don't even know if this is in your coverage area, so forgive me if it isn't, but I'm obsessed with the Spanish banking story right now. And the argument that they keep making for this is that the deleveraging story you're seeing in the public finances, specifically in the periphery, in Greece, Italy, Spain, is one that provides more loan opportunity for the domestic markets, not only there, but in broader Europe. Do you agree with that? I mean, that's one of the cases that BBVA is making for Banco Sabadell. It's one of the cases Santander is making for continued outperformance in Spain. Do you buy that for broader Europe?
Yeah, I don't want to be unpolite, but I think up to a certain point, in the sense that I think consolidation makes sense even in a market like Spain that has done some consolidation over the years. And I think inevitably this is for the, the step forward after eventually this rate cycle change, because I think at the end of the day it's banking, especially in Europe, and Europe remain a very bank centralized market, even though private credit is growing. I think it's the economy of scale is very important. So someone like BBA, if they manage to bag Sabadell, they will grow, I believe, at 24 or 23% in the SME, and that could be a powerful engine for BBVA growth. So I understand the strategic case for BBA to take over Sabadell. I think in other markets, like for example Italy or France, there is another strong case for having a bit more domestic consolidation. Cross-border will come, but I think also we're still a few years away.
So you mentioned, it's interesting that you say you see the merits of the BBVA deal, because there's so many criticisms that the synergies aren't actually aligning, and this is more of a takeover story than anything else. And we're going to have to get you on to nerd out about that closer to when we get those details. But you mentioned France as well, and this cross-border consolidation story is something that Emmanuel Macron has been very, very vocal about. Walk us through what we need to make that more of a possibility.
Yeah, people, they always say it's about the rules, about the ECB, etc. I think also we need a upgrade in the management thinking in Europe. I think also lots of those managers are very good CEOs, but I think also they terms too much in terms of localize. A French bank CEO thinks a lot about France, which fair enough because probably it's in his KPIs or her KPIs. But I think we need to step up this thinking. Because if you look, for example, at biology, we make a lot of progress in terms of RNA, etc. And I cannot believe that a simple product like the mortgage needs to be so complicated to roll over from France to Italy or from France to Spain or to Germany. I think those are pretty simple products. And I think also with the technology we have, also we should be able to roll these products in different markets. And so I don't buy when they say, yes, but we have different rules in France versus in Germany or Italy.
A final question to you then. It's interesting we're talking about cross-border consolidation. I should point out that the SocGen CEO was kind of rolling their eyes on it and saying, it's a lovely theory, to your point, but it's not something that's actually doable for that very reason. When it comes to Germany, on a macroeconomic standpoint, we're talking still about Germany kind of being with the manufacturing weakness, still the sick man of Europe, and that seems to be the phrase that Canadians continue to use. It's also incredibly overbanked. There's so many products there. No bank has really been able to go there and make and grow in the way that they can. I think there's something like 1,000 unprofitable banks in Germany.
Yeah.
Who is succeeding in Germany outside of Deutsche Bank? Who can make that work?
Yeah, that's true. But let's remember that 2/3 of the German banking industry is actually public sector, cooperative, and then the Landesbank and the savings bank. So that's, I think, the profit is not the main objective of those banks. So I think we need to concentrate on the third, which is the private sector banks, so the Commerzbank, the Deutsche. I think also some banks, like, for example, ING, they've been growing mostly on the digital part.
Yeah.
The French banks are very keen, but the problem of Germany is that 1/3, which is private, is very competitive. Yeah. Everyone is there, the Canadian, the Japanese, the Asian banks, and therefore actually lending to corporate or to consumer, it is not a very profit-enhancing exercise. Yeah. So we need some sort of rationalization in terms of the offer. And also there is a lot of talk of Germany being the sick man of Europe, the rehearsing the playbook from the early 2000s. I think Germany also, unlike the other European countries, has a lot in terms of budget. Because they're the Spartan of Europe. So in theory, if they're willing to, they could unleash a lot of investment into the economy, especially to move the manufacturing to a more, let's say, green pasture. So I think there is a lot of strengths in Germany that are at the moment overlooked.
A fascinating story. And again, another contrarian view when everyone's talking about weakness there. Filippo Alloatti, we have to leave the conversation there. Head of financials over at Federated Hermes. We thank you so much. However, we do continue the conversation on Germany, the third largest economy in the world. The output there unexpectedly shrinking in the second quarter. We're going to dive into the numbers and what it means for the ECB, given the fact they actually had growth in France and in Spain. We'll dive in. Stick with us. This is Bloomberg. Welcome to The Pulse. I'm Kriti Gupta. I want to get some of the other stories we're watching this morning. President Joe Biden has criticized the Supreme Court's conservative majority for what he called, quote, extremism in its recent rulings. Speaking in Austin, the president proposed new ethics rules and term limits for justices. The U.S. president said the court's decisions on issues like abortion access had undermined long-established civil rights principles. Now, sticking what's going on in U.S. politics, North Carolina Governor Roy Cooper has withdrawn his name from the race to become Kamala Harris's running mate. The Democrat worried that his Republican lieutenant governor could try to assume control if he left the state. Now, Cooper said in a statement, it's not the right time for him to be on a national ticket. Meanwhile, Donald Trump said he expects to eventually debate Kamala Harris. He had previously declined to commit to appear at a scheduled face-off in September. Now from U.S. politics to U.K. politics, Britain's new Chancellor Rachel Reeves has announced a slew of measures to shore up the U.K.'s public finances. She used a speech in Parliament to accuse the previous Conservative government of running up a £22 billion black hole and signaled she may have to raise taxes to help balance the books.
We have inherited a projected overspend of £22 billion. If left unaddressed, it would mean a 25% increase in the budget deficit this year. I am announcing today that I will hold a budget on October the 30th, alongside a full economic and fiscal forecast from the Office for Budget Responsibility.
Now from the UK budget over to the German economic data, where output unexpectedly shrank in the second quarter, casting a shadow of the resilience of growth seen in the euro area's next three biggest economies. Let's bring a little bit more context into this conversation. Bloomberg's Oliver Crook standing by in Berlin. Ollie, how do we digest these numbers?
Yeah, so listen, we got a lot of numbers today out of Spain, France, Italy, Germany, and they all told slightly different stories. I think we should start probably with Spain because it was really the blowout figure here, where on the CPI data it came in a lot less hot than had been anticipated, 2.9%. That still feels pretty elevated from the ECB standpoint, but the expectation was for 3.2%, and that's the year-on-year figure. What you really need to pay attention to, Crady, is the month-on-month where we saw prices drop by almost 1 full percentage point. In Spain, they dropped by 0.7% from June to July. That is exactly in the direction that prices want to be going. As far as the ECB is concerned, the GDP figure came in quite a bit stronger than anticipated, 0.8%. The estimate was for 0.5%. Similar story in France, not quite as much of a blowout, but grew at 0.3%, about 10 basis points better than had been anticipated. Italy, a little bit more slower, just coming in line with estimates of 0.2% growth. But really, the one that is kind of come against all of that is Germany. We're very sad to say it's the odd man out. It is potentially, again, the sick man. It was supposed to grow by about 10 basis points this quarter. It contracted by 10 basis points. So that's really not the direction you want to be seeing the biggest economy in Europe going to this morning.
Well, Ollie, you talked a little bit about this. You hinted at what the ECB is going to be thinking about. Is this the case then for rate cuts? Are they responding to that German story despite the massive strength you pointed out in Spain?
Yeah, well, listen, I think that they still have a little bit of time to decide. And what I think is interesting is that, we still have the German CPI figure that's going to come a little bit later in the afternoon. That is going to be very closely watched. That's expected to come in at 2.5%. Again, biggest economy, still pretty hot in terms of the number. The headline number for the Eurozone also supposed to come in at 2.5% a little bit later. But listen, what is interesting to me is the sort of dichotomy you have between what the ECB is saying and what the market is hearing. You have Lagarde making it very clear at the rate decision the other week that September is wide open. Schnabel has said that she's very concerned about services where prices are feeling very, very sticky. Nagel, the Bundesbank president, saying that they need to stay restrictive until you hit that 2 percentage point. We are not there yet. Even Guindos, more of a sort of dovish figure, saying that inflation is going to be at the current level through the rest of the year. You hear all of that, but the market is still pricing a 90% cut, the probability of a rate cut in September by 25 basis points. So over the next 2 days, we're going to get a bunch of CPI data that the ECB will be watching very closely. That rate decision is on September 12th. We still get one more print in August, but the ECB is saying one thing, the market is saying another, and it's going to be very interesting to see how that unfurls over the next couple of weeks.
All right, so that's the ECB. Bring it back to, say, the politics of Germany, if we can. The latest there.
Yeah, well, listen, I mean, this is the situation here in Germany. When you see that contraction coming in, it's not something that anyone is very happy to see. And it's very hard to see how the traditional engine of Europe is going to pick up and actually get moving forward. As I said, you had a contraction in the second quarter. The estimates were ranging from they were dead at the bottom of the estimates of anything that had been anticipated. And we also got the regional CPI data, Crady. So we don't get that print till for another few hours. But if you look across all of the regions of Germany, whether it's Hesse, Bavaria, Brandenburg, Saxony, Baden-Württemberg, all of those inflation numbers went up in the month of July. That is not the direction of travel you want to be seeing. You saw the IFO Institute putting out some research after that GDP figure came out for this quarter, saying that basically the German economy is still stuck in crisis. And by the way, the third quarter is not going to look any better. So what we need to look at are a number of the companies that are reporting in Germany. We have Volkswagen out on Thursday. There'll be something to watch very, very closely. I will try to leave you with a little bit of optimism, though, Crady, from Deutsche Bank, where the company that really lends to many of these manufacturing companies that have been in a manufacturing recession for 2 years now, saying that maybe, just maybe, they've turned the corner. Have a listen to the CFO.
loan growth has been more sluggish than we would like to have seen. We'd been anticipating it a little earlier than now. And that's true also in Germany. We still have had a net decline in our mortgage book, for example, this quarter. Some of that's deliberate, some of that's sort of the market environment. Mm-hmm. I'd say the German economy has found its footing, and so we're seeing growth now. It's marginally positive, but we think accelerating now in the second half and into 25.
So, Creedy, despite all the pessimism and some of the really poor surveys and data out, at least potentially in the future, the Deutsche Bank sees maybe that the German economy has found its footing.
All right, Bloomberg's Oliver Crook giving us a little bit of optimism on a relatively doomsday day in Germany. We thank you so much. Coming up, we're going to see if that vibe continues from the macro to the micro. We're going to talk about U.S. tech earnings next. Stick with us. This is Bloomberg. So we covered the politics, we covered the macro. Let's talk a little bit about some of the other earnings stories we're watching, not in Europe, but across the Atlantic, and get more on the tech story. Bloomberg's Tom McKenzie all over that. Microsoft in focus.
Yeah, in focus for today. And the focus for Microsoft, it comes down to the cloud business. So Azure, to what extent is that going to perform well? Now, expectations are that they're going to come through with growth within Azure, within cloud, of about 30% for the most current quarter. Top line revenues expected to increase about 15%. But here's the context, as you know well, Critty, in line gains in terms of earnings, an inline level in terms of the numbers that come through will not be enough for many investors because expectations are so high. And then there's a question about monetization of AI as well. Look, Alphabet did pretty well on cloud. That suggests that Azure's performing fairly well. But again, are they able to properly monetize the investments they're putting in place? That is another key line. Watch the CapEx, watch the spending on AI. Expected to be $13.3 billion. Above that could pose a challenge.
All right. The pain of being an A-plus student, apparently. We'll see if Microsoft wins that battle. Bloomberg's Daybreak Europe anchor Tom McKenzie, we thank you so much for giving us that crucial context. Up next, the conversation continues. Bloomberg Brief with Danny Berger and Manus Cranny leading you up to the New York stock market open. Stick with us. This is Bloomberg.